So, Lee, what are we here to talk about today?
Extreme weather's forcing insurers to make big changes to their business model and get more creative. So what impact might that have? Insurers have had to pay out more than $100 billion a year in natural catastrophe losses every year this decade. This year has already seen heavy insured losses, with January's wildfires in LA costing the industry $30 to $40 billion. LA is just one of many destinations where residents are moving into harm's way. In the US, people are flocking to the Florida coastline and to parts of the Southwest prone to heat waves and wildfires. And in the UK, more homes are being built in flood zones. Across many markets, climate change is pushing up insurance premiums. Economists from NYU, Rice, and the Federal Reserve Bank of Dallas recently found that rising insurance premiums have pushed up mortgage delinquency rates and also are prompting homeowners to rack up more credit card debt. Some lawmakers and economists even worry we could start to see tipping points where whole neighborhoods are deemed uninsurable, and the resulting collapse in real estate prices could send a shock through the economy. But insurers have a number of products to try and deal with these growing risks. Catastrophe bonds, which transfer some of the risk of wildfires, hurricanes, and other natural disasters to bondholders, hit a record $18 billion of issuance in July. The bonds can provide higher yields compared to government bonds, but investors also risk losing their money in the wake of a catastrophe like another Hurricane Katrina. Insurers have also developed parametric products. These pay out based on preset triggers, such as the wind speed of a storm or a certain level of rainfall. Proponents of parametric insurance say it can be cheaper and it pays out immediately after a crisis. But it's not perfect. There's a risk for buyers of parametric insurance policies that when a catastrophe hits, it may not breach the threshold set in the contract. For example, when Hurricane Beryl swept through the Caribbean last year, it left hundreds of thousands of homes in Jamaica without power. But it narrowly missed an air pressure threshold that would have triggered a payout. Insurers are also pouring money into new technologies like satellite imaging, artificial intelligence, and geospatial data in order to better predict climate risk. We've also seen the growth of state-backed insurance schemes. In many of these schemes, governments will backstop risks when private market prices get too high or when private insurers withdraw altogether. For example, policyholders of Florida's state-backed scheme, Citizens, more than doubled from 450,000 in 2020 to over 1 million in 2023. Insurers are getting more creative with the technologies and financial instruments that they use to deal with this challenge. But even so, the growing severity and intensity of climate disasters is set to test the future of the insurance industry.